Today, I want to talk a little bit about the impact of pension contributions on tax savings for higher earners in the UK. My name's Esther Clemmey and I'm a Chartered Financial Planner at Integrity 365. So according to the IFS, around 5% of earners in the UK are earning six-figure salaries of over £100,000. If we look back 10 years, in 2015, the equivalent to £120,000 today, factoring in CPI inflation, would have been around £87,000. So although there have been some changes to tax thresholds, these have not been in line with inflation, which means that someone who was earning £87,000 in 2015, the equivalent of £120,000 today, would have been on a much more favourable tax scheme than someone earning £120,000 today. So for context, someone earning £87,000 in 2015 would have paid income tax and national insurance that took them to a tax rate of around 33.5%. That's not factoring in anything like student loans, pension contributions, simply looking at income tax and national insurance. Meanwhile, someone on £120,000 today in 2025 would be taxed at a minimum rate of 39%. So in 2015, the same equivalent salary would have been taxed 33.5%, and in 2025, that tax rate is a minimum of 39%. This rises much further once you factor in other aspects such as student loans. So how can a higher earner reduce tax? Now, the most significant approach to this is via pension contributions. What I'm going to do is I'm going to show you an example of an individual who earns £120,000. They are an employed person, so that's £120,000 salary. And what we're going to do is talk about the use of salary sacrifice to reduce the amount of tax they pay and increase their pension contributions. Salary sacrifice, in very simple terms, is when an employee gives up part of their salary in exchange for a pension contribution from their employer, thus paying less income tax and national insurance and having a higher increased pension contribution. To keep it simple, we're using an example of a £120,000 salary. The taxes involved are going to be income tax, national insurance, and student loan. I've not included any forms of bonus or other forms of remuneration such as company cars. So this individual is currently sacrificing 3% of their annual salary into their pension. Their employer is also contributing 5%. The individual we're using in question has a Plan 2 student loan, which means that they are paying 9% extra tax, effectively, on repaying that student loan over a certain threshold. The student loan also has an interest rate of 7.3%, so they're paying back capital and interest on that every month. Someone in this situation has a take-home pay of £66,880 after tax each year. Their total tax rate is therefore around 41.27%. £9,600 is going into their pension each year. By increasing the employee's salary sacrifice pension contributions from 3% to 10%, their total pension contributions rise to £18,000 a year. Their take-home pay is only reduced by £2,436, and they're saving £5,964 in tax. So that reduces their overall tax rate from 41.27% down to 36.3%. Not quite at the lows of 2015, but a lot better, especially factoring in student loan. So they pay a lot less tax. There's only a 3.6% decrease in their take-home pay, or monetary figures, that's £203 per month. And in return for that, they're putting an extra £8,400 into their pension. So that's an extra £700 per month into their pension. So yes, there is a decrease in their take-home pay of about £200 a month. However, they're saving almost £6,000 in tax, and they're putting an extra £8,400 into their pension. What's not to like? How this actually works is on a £120,000 salary, the 20,000 over 100 grand falls into the famous tax trap of up to 60% tax. The reason this is so effective is because by increasing those pension contributions, it effectively decreases the individual's salary down back to around £100,000, returning the individual's personal tax allowance. So when someone is earning over £100,000, they actually give up £1 for every £2 over that of their personal tax allowance, which is currently £12,570 a year. So by increasing those pension contributions, they regain that allowance. If relevant, an individual can also regain free childcare through salary sacrifice. So if this individual is taking their salary back below £100,000, they'll regain those 30 hours a week of free childcare, which can be hugely significant, especially alongside the pension contributions. And particularly for younger, higher earners, increasing these pension contributions like this, the compound interest effects on that over time will have a massive impact on your retirement savings when you eventually get there. It may seem a long way off. So we've used an example there of £120,000, but this does also work for other higher rate taxpayers. So for example, using the same approach, moving from 3% to 10% of salary sacrifice on pensions, on an income of £80,000, that would increase pension contribution from £6,400 all the way up to £12,000 and save tax of £2,856. On an income of £50,000, it would take pension contributions from £4,000 all the way up to £7,500 and save £1,295 in tax. So you can see the massive impact that this can have on future planning, on decreasing tax and redirecting that tax towards your pension. In these examples, I've used an example of someone who is employed. However, this could also apply to the self-employed. That would require another whole explanation in itself, but please do get in touch to find out more if you're a higher earning self-employed individual and want to understand how this could work for you. There are a couple of downsides to salary sacrifice, and it's important to provide a balance to this conversation and mention those. The first is that it could reduce the borrowing capacity that you have for mortgages or loans. Effectively, salary sacrifice reduces the value of your taxable salary, which means what is declared to HMRC is lower, and that is used to determine how much you can borrow on a mortgage. It can also lower any death in service benefits you have via your employer. So for example, if you have a life insurance with work that is 4 times your salary, by reducing your salary, that does actually also affect that life insurance. So that's just something also to bear in mind. Pension contributions are not the only way that an individual can reduce how much tax they're paying and redirect those funds for their own benefit. One strategy that a lot of higher earners use is if you're earning any form of bonuses at work, you can actually request that those are paid directly into your pension. Not all employers will do it, but a lot will, and therefore, again, you're bypassing the tax, the national insurance and the student loan on that bonus, and you're putting it towards a future for yourself. The other thing is you can actually also invest in startup investments. So schemes such as enterprise investment schemes, seed enterprise investment schemes, or venture capital trusts, which can provide income tax relief also. I would always recommend when you're looking at any of these planning options, take advice from a financial planner. If you are a higher earner of any form, a financial planner can help you to streamline everything that you are doing in your finances, and they can help you to save tax in the long term that will benefit you and make sure that you're planning for the future that you want. Hopefully this video has been of some use to yourself, and please do feel free to share it amongst others who may also find it useful. If you're interested in the services that we provide, please do get in touch to find out more. We'd love to speak to you.